Hello students, good evening. Welcome back to Global Online. So if you are preparing for the UGC NET December attempt 2025 from Commerce or Management Paper 2 background, accounting and auditing is the very important unit. In this session, I will be covering 20 plus short MCQs on financial ratios in which all the ratios will be covered. You will learn how to solve the ratios, what is the formula of that, and what kind of questions can be asked in the examination. So this is really very important session for you. Please watch this video, the lecture till the end, and share as maximum as you can. But before starting the session, very important thing I would like to share with you all. If you are seriously preparing for the upcoming NTA UGC NET examination, which is December attempt 2025, we have come up with the paper 2 complete course for management and commerce people. In this course, you will be guided by the experts to increase your score in the examination and qualify this examination. In this course, you will get complete video lectures which will cover your all the units. Complete syllabus notes will be provided. Mock test will be provided to you, so you will practice more and more and your confidence will be building up, right? PYQs with explanation, doubt clearing sessions, marathons, these all things, all materials will be provided to you. Okay. So if you want to join this course, just contact on this number. You can do WhatsApp message or WhatsApp call and join this course. Okay. Or else you can also go to the Play Store, download the application, that is Global Online. Okay. Search Global Online on the Play Store. You will see this logo on that application. Download that application and you can join the course. Okay. So this is your first question. Debt equity ratio of 2:1 means what? Okay. So we have already covered the debt equity ratio in the previous session. What is debt equity ratio? How it is calculated? What is the formula of this? Right. So 2:1 means what? A, shareholders funds are twice the debt. B, debt is twice the shareholders fund. C, debt and equity are equal. Or D, none of the above. So the right answer is option B, debt is twice the shareholders fund. Okay, if the debt equity ratio is coming 2:1, that means it is the debt is twice the shareholders fund, right? So how we calculate it? The formula for debt equity ratio is to debt divided by equity. Correct? Debt divided by equity. Correct? So the debt equity ratio is financial metric that shows the proportion of the company's financing that comes from the borrowed fund, that is debt, versus shareholders fund. Clear? So what is debt? Debt, that means the long-term borrowing such as loans, debentures or bonds, and equity, that means the shareholders fund. Okay, we issued the shares, we have the fund from the shareholders. Correct? That is your equity, which includes share capital and reserves also. Correct? So how we calculate debt equity ratio? See, these 4 points will clear your all the doubts. See, the ratio of 2:1, right? That means that every 1 rupees of equity, correct, the company has 2 rupees of debt. If the ratio is coming 2:1, that means your 2 rupees is debt and 1 rupees is equity. That means you have 1 rupees of equity. Uh, every 1 rupees of equity, the company has 2 rupees of debt. Getting it? If you have 1 rupees equity, getting it? If you have 1 rupees equity, right? That means you have 2 rupees of debt. Getting it? That means if you have 2 rupees of equity, you will have 4 rupees of debt. Getting it? The higher the debt equity ratio, for example 3:1, if it is 3:1, that means it indicates the greater dependence on borrowed funds. Getting it? That means company is borrowing more fund and equity is less than that. Getting it? That will be give the company, or it will push the company into the risk. Getting it? If the lower debt equity ratio, for example it is 0.5 to 1, that means company is relying more on the own funds. Okay, that means the company is going under low financial risk, right? Thus the debt equity ratio helps in understanding the company's capital structure and its balance between the ownership fund and borrowed fund. Correct? Clear? Now moving to the next question. Which of the following is measure of short-term liquidity? Current ratio, debt equity ratio, net profit ratio, or return on asset? Okay, I'll give you 10 seconds to answer this question in the comment box. You have to give a answer in a comment box. A, B, C, D, whatever it is. Okay, so right answer is option A, that is current ratio, right? Current ratio is correct answer. What is the formula of current ratio? Current assets divided by current liability. Here, current assets divided by current liability. This is the formula, and it is very important to understand the formula, by heart your formula, because in the examination it won't give you the formula in the paper. You have to by heart. याद करना पड़ेगा आपको. The current ratio is financial metric used to measure company's ability to meet its short-term obligations, right? Those due within a year. Short-term obligations, that means which is within a 1 year, right? Which is called short-term. Using its short-term assets. See, what is current asset? It includes items like a cash, account receivable, inventory, or other assets that are expected to be converted into the cash within a year. Okay, the short-term period. If any asset which is convertible into the cash, that is called current asset. And what is current liability? That means the obligations. Okay, the payable things. For short term, that means within a 1 year, if there are some liabilities, there are some payable things, that is called current liabilities. For example, like account payable is there, short term loans are there, debts are there, which will be settled within a year, that is called current liabilities. If it is more than 1 year, it won't be called as a current liability. Okay, so the formula for that is current ratio is equal to current asset divided by current liability. Clear? If current assets are 2,50,000 and current liabilities are 1,25,000, what will be the current ratio? So I have given you the formula. You have to answer it in a comment box. Fatapat. Current assets are 2,50,000 and current liabilities are 1,25,000. It's really very easy question. Right answer will be 2:1. So what is so hard in that? Okay, we had the formula. Current assets divided by current liability. So what is current asset? 2,50,000 divided by 1,25,000. Clear? Cut the zeros, right? 250 divided by 125. Obviously 250, that means 2 and 1. 2:1, which is 250. It is a half of 125. Clear? So 1:2 will be the correct answer. Clear? Next, which of the following is measure of overall profitability? Gross profit ratio, net profit ratio, return on investment, or current ratio? Give answer. All right. So right answer is option C, return on investment. Clear? See, the higher ROI, return on investment, that means it indicates that company is effectively utilizing its capital to earn more profit. Getting it? If the return on investment is higher in the company, that means the company is using their assets to generate more profit, right? If the lower ROI, that means company is not efficiently using those assets to generate the profit. Clear? The efficient use of resources or poor profitability, we call it. Inefficient, sorry, not efficient, inefficient use of resources. Clear? For example, if EBIT, okay, that means earning before interest and taxes, 50,000, and capital employed 2 lakh. Okay, then what will be the return on investment? 50,000 divided by 2 lakh into 100, that will be 25%. That means company earns 25% return on the capital it has employed. Correct? So that is how we calculate the return on investment. Sales are 10 lakh, gross profit 2,50,000. Find gross profit ratio. What will be the gross profit ratio? 15%, 25%, 29%, or 30%? What will be the gross profit ratio? We have discussed what is gross profit ratio, right? How we calculate it. We have already discussed in the previous sessions. So the right answer is 25%. See how we calculate gross profit ratio. Gross profit divided by sales into 100. Okay, so we have gross profit 2,50,000 and net sales 10 lakh rupees. Correct. So net sales. So gross profit is 2,50,000 divided by sales, that is 10 lakh rupees, into 100. So what will be the answer? 25%. If the gross profit ratio is 25%, that means business earns 25 rupees as gross profit on every 100 rupees. Getting it? On every 100 rupees, right? The company is earning profit 25 rupees. Gross profit. Getting it? On a 100 rupees sale, basically. If the sale is 100 rupees, the company is getting 25 rupees gross profit. If the higher gross profit ratio, that means better efficiency in production and sales, effective pricing, or lower cost of goods sold. Clear? That can be possible. Lower GP ratio, that means may indicate high cost of production, inefficient management, or low selling price. Okay, this will be the possibilities. If the higher GP ratio, that means the higher gross profit. Getting it? That means company is efficiently working, producing the goods, and selling price is also good. Getting it? If the lower GP ratio, that means company is not efficiently using the what we can say, the products or the sales functioning, right? Or the sales. If the sales are not good, that means your GP ratio is not good. Clear? Next, net profit after tax is 1,20,000. Equity capital is 6 lakh. Find ROE. Okay, 20%, 18%, 15%, or 25%. What will be the answer? So right answer is 20%. See, ROE is equal to net profit divided by shareholders equity. Okay, so basically ROE what? Return on equity. Clear? So if the net profit is 1,20,000 and shareholders equity is 6 lakh into 100, that will be 20% of your ROE. If the ROE is 20%, that means that every 100 rupees invested by shareholders, the company generates 20 rupees of profit. Clear? Higher the ROE, that means better utilization of equity capital and strong profitability. And if the lower ROE, that means it suggests inefficient use of shareholders fund. Company is not sufficiently using the shareholders fund and it is not generating profit from this kind of fund. That means shareholders fund. Clear? Next question. Earning per share EPS is calculated as, okay, earning before interest and tax divided by number of shares, net profit after tax divided by number of shares, net profit before tax divided by equity capital, or gross profit divided by number of shares. Okay, give your answer. Only 10 seconds will be given to you. Okay. All right. So right answer is option A, earning before interest and tax divided by number of shares. Operating ratio of the company is 75%. Sales are 20 lakh rupees. Find operating cost. Okay. So before that, we need to know what is the operating cost and what is the formula to calculate the operating cost, right? So first thing we'll have the right answer. Then I'll explain you how we can calculate. So 15 lakh is the answer. So first we need to understand, we need to know what is the formula for calculating the operating ratio, right? In which the operating cost is there. See, operating ratio is equal to operating cost divided by sales into 100. Okay, what we have operating ratio, we have sales. Okay, we don't have operating cost that we need to calculate into 100. If we do, we'll have the operating cost rupees 15 lakh. Clear? Operating cost is not given. When we calculate, we cross calculate it, we'll have the right answer. So please remember this formula, operating ratio, which is operating cost divided by sale into 100. You will have operating ratio. Okay. Next question is, if earning before interest and tax is rupees 4 lakh, total capital employed is equal to 10 lakh, and then what is ROC? That means return on capital employed. Okay, 30%, 35%, 40%, or 45%. So right answer will be 40%. Okay, so before uh, heading towards the answer, we need to understand, we need to know what is the formula of ROC. That means return on capital employed, right? So earning before interest and tax divided by capital employed into 100 जब हम करेंगे, then we'll have the 40% of ROCE. Okay, 4 lakh rupees earning before interest and tax, 10 lakh rupees capital employed was given, then into 100 when we do, we'll have the 40% of ROCE. Okay, remember the all formulas that I'm giving to you, because only these formulas will help you out in the examination to increase your score, right? Sometimes it is asked to calculate, sometimes it is asked the missing figure in that. Okay, next, which of the following ratios shows the relationship between the net profit and net sales? Net profit ratio, return on equity, return on assets, or operating ratio? Very easy answer. You all have to give the right answer in the comment box. For that, only 10 seconds will be given to you. So the right answer is option A, that is net profit ratio. Okay, how we know that there is a relationship between net profit and net sales, right? In which ratio? So that is net profit ratio. Net profit divided by net sales into 100. That will be net profit ratio. Remember this formula. Okay, very important. Net sales is equal to 12 lakh, net profit is equal to 2 lakh 40,000. Find the net profit ratio. Just we have discussed the net profit ratio, right? So calculate it and let me know what will be the correct answer. 20%, 18%, 15, or 25. So right answer will be 20%. Okay, so net profit ratio is equal to net profit divided by sales into 100. So we have net profit 2 lakh 40,000, we have sales 12 lakh rupees. When we calculate, or we divide it, sorry, we multiply it with 100, we'll have the 20% of net profit ratio. Next, return on assets indicates. See, these kind of questions can be asked in the examination, right? So if you want to know the theory part of these ratios, financial ratios, see, it is not necessary that it should be only calculative or it is numerical part. Sometimes they ask the theory part also, right? So in the previous session, I have discussed both the part, the numerical, the calculative part, and also the theory part. If you have not watched that video, please go and watch. I have given the link in the description box. Okay, so return on assets indicates profitability of sales, profitability of shareholders fund, liquidity of assets, or efficiency of assets utilization. So return on assets, we calculate it to know the efficiency of asset utilization. When company has the assets, okay, how company efficiently using those assets to generate the profit, right? That we need to understand whether these assets are useful or not, right? So return on asset is equal to net profit divided by total assets into 100. Then we'll have ROA. Remember this formula. Earnings per share, EPS, is calculated as. Now they are asking about the formula. Formula of EPS. Net profit after tax divided by number of equity shares. Net profit before tax divided by share capital. Earning before the interest and tax divided by number of shares, or dividend divided by number of shares. Okay, so right answer is option A, that is net profit after tax divided by number of equity shares. Okay, next, a company has net profit after tax 8 lakh rupees and 2 lakh rupees equity shares. Find EPS. Okay, rupees 2, rupees 4, rupees 6, or rupees 5. Calculate it and give me the answer. Right answer will be rupees 4. See the formula. EPS is equal to PAT. PAT means profit after tax divided by number of shares. So we have net profit after tax rupees 8 lakh and number of shares are 2 lakh. Okay. So when we calculate it, we'll have the rupees 4. Clear? So that means rupees 4 will be the profit for every share. Number of share. Clear? Number of share. So for example, if we have one share of rupees 100 rupees, for every 100 rupees the company is generating rupees 4 profit. Clear? That is the reason why we calculate the EPS, earning per share. Next, market price per share is equal to rupees 120. EPS is equal to rupees 10. Find price earning, that means PE ratio. Okay, 10, 12, 15 or 20. So right answer will be option B, that is 12. So PE ratio का formula है market price divided by EPS. Okay, so we have market price of rupees 120 and EPS is rupees 10. Okay, when we calculate this as a uh, in a formula, we'll have rupees 12 as a PE ratio. Okay. Next question. If dividend per share is equal to rupees 6 and EPS is equal to rupees 10, then dividend payout ratio will be what? 40%, 45%, 50% or 60%. What will be the correct answer? The correct answer will be option C, rupees 50, sorry, 50%. Okay. Dividend payout ratio, DPS divided by EPS. Okay, dividend per payout ratio is equal to earning per ratio into 100. Okay, so we have DPS 6, we have EPS 12 into 100. When we do, we'll have the 50% of DPR. Next, if DPS is rupees 5 and market price per share is rupees 100, then dividend yield ratio will be what? Okay, 4%, 5%, 6% or 8%. It will be 5%. Okay, so dividend yield is equal to DPS divided by market per share into 100. So we have DPS 5, market price 100 into 100. When we do, we'll have the 5% of dividend yield. Okay. So in this session, we have discussed some of the different ratios also that we have not covered in the theory session as well. So these are the ratios can be asked in the examination. So every ratio I'm going to cover in the sessions, in the MCQ sessions. So you will have an idea like how to calculate it, what is the formula and what can be asked in the examination. Okay, so no one will be uh, removing your marks or decreasing your marks in the examination. Definitely 100% you will have mark for the these kind of questions. Okay, so thank you so much for attending the session. Have a great day. See you in the next session.